Welcome to Walk Away Wealthy. I'm your host, Alan Terrell Gregory. If you're thinking of selling your existing business or looking to untangle yourself from your old business so you can start a new one, you came to the right place. Today, I have a very special guest, Brad Pries. Welcome to the show, Brad.
Thanks, Alan. Appreciate it.
So tell us a little bit about yourself.
Well, I'm 57 years old. I recently sold my business in 2021. I didn't really get a chance to retire because I wanted to continue working in the industry. I've got 4 kids. I live in Minnesota. I'm just living the dream.
Sounds great. So, how and why did you get started helping business owners with retirement?
So that's a great question. So I went through an exit, as I said earlier, in 2021, and I decided since my exit wasn't exactly the way I'd hoped it would end, I wanted to learn more about exit planning. So I decided I really wanted to help other business owners not make some of the simple mistakes that I made in my exit. I've got time on my hands. I've got an opportunity to meet with other owners. So I really wanted to reach out and try to help business owners. So that's how I got into it.
So, what kind of business was it and what kind of mistakes did you make?
Great question. So we were a fintech company. We specialized in outsourcing back office, middle office functions for registered investment advisors, bank trust departments, and broker dealers. So, in other words, we did trading, billing, performance reporting, due diligence on money managers, contracting with money managers. So, all the work that an investment advisor would do on the back end once they have a client, we would fulfill all that for our clients. So, as we built that out, got it pretty big, about 20 billion in assets towards the end when we sold it. We went to raise capital, Alan, and because we continued to grow, and as we grew, as you know, you are always as an entrepreneur either issuing new capital or raising debt or some sort of capital structure to keep the business growing. So we went to the capital markets in 2020, right before it was end of 2020, so getting close to COVID. Everyone we talked to in the capital markets, mostly PE firms, had an interest in the firm, but it became pretty clear at that point that no one wanted a minority stake. So that's the part I wasn't prepared for. So I was prepared to take a minority stake, continue to grow the business for another 5 years, and have my exit somewhere down the line. But as we reached out to more and more firms through our banker, it became obvious that if we were going to get the next level, we really had to sell the majority or sell the company. So during that period, I realized it was probably too late to incorporate some of the wonderful things that you can do ahead of time to prepare your valuation for exit. So the biggest thing I did wrong probably was I just wasn't prepared as I should have been.
Hmm. So, what are some of the things you would have done if you could like rewind the clock? What are some of the things you would have done?
Boy, there's a lot of things I would do differently. I think number one, I would prepare better for myself personally. So, as you know, in the SEPA program, we talk about the three-legged stool, which is business, personal, and financial, and all things need to be equal in terms of when you're ready to exit. And I told you I hadn't really planned on exiting. It was more of a capital raise when we went into it. So I had done no personal planning. In other words, I had no idea what was going to come next in my life. And that was the biggest mistake for me because I get bored easily and I'm an entrepreneur for 35 years. So sitting around the house or playing golf or fishing or whatever it is I was going to do with my spare time got boring pretty quickly. So I do think that business owners are well serviced if they can figure out what they want to do once they retire or once they sell the business. I think it's critical to be happy.
So, how did you figure it out for yourself?
Our firm had implemented an operating system back in 2017 called Traction or EOS, if you're familiar with that. So I'd always been familiar with business operating systems. I went to my implementer after I retired. His name was Greg Cleary. I talked to him. He said, "Hey, come be a guide for us." I researched everything that they do in addition to what EOS had done. I just thought this is a really good fit for me. I really like the idea of implementing kind of the four intangibles, right? The human capital, the social capital, the customer capital, and structural capital, because that's kind of operations is where I lived and breathed in my industry. The difference for me, though, was I didn't see exactly how the operating system was adding value to my underlying business valuation when I was running the program internally. So that's what led me to SEPA to tie it all together. So for me, the certified exit planning advisor paired with that business operating system coaching is a really, really wonderful way to help a business owner stay connected, stay accountable, and hopefully increase their business valuation.
So those same operating systems that you use for business owners in your new coaching business, is that something that you used in your previous business?
Yeah, I would say 2.0 version, right? So version 1.0 was EOS for us. EOS has some great things, and there's some things that I wish they did better. So as we looked around at more operating systems, there's eMyth, there's scaling up, there's 5 or 6 different business operating systems out there. So we kind of, when I looked at Pinnacle had kind of taken the best from every one of those different solutions and put it together. And the tool set is amazing. We have 90 different tools to help business owners in any facet of their business, including strategic planning, which I think was one of the areas that EOS struggled in. So that's why I leaned towards Pinnacle.
So what are some of the common challenges business owners face when thinking about retirement?
I think we just nailed it. It's not being personally prepared. I mean, my personal experience is I think you're so caught up in your business, and the process of going through the sale is so intense. It took us almost 15, 16 months to go through the process. You just don't really focus so heavily on yourself as you are focused on the business. And I think when it finally hits you after the transaction is completed, the biggest mistake people have made is they aren't personally prepared. They might have an investment advisor or financial planner that helps them with the potential capital coming out of the business and managing it. But it really is that personal time, especially if you're a younger owner selling in your 50s, maybe even up to your early 60s. I see most business owners seem to be unhappy, mostly personally. I think they get disconnected. They feel irrelevant because you were in your business, you were someone, right? You were a big wig in the business, you ran the business. So staying relevant, I think, is probably the biggest challenge most business owners face when they retire.
Got it. So how long, and going back a little bit, so how long did it take from the transaction being done to the time that you started in this new thing? Was there a gap there?
Yeah, it was about 6 months of learning, taking the SEPA. So I left the business in 2022, September of 2022. I launched this coaching business back in March of this year. But having that EOS experience, having run and implemented that for our team for 6 years, I felt like I think I could add a lot of value since I've been through it personally.
So you didn't take any time for yourself in terms of like golf or fishing or anything like that? You just kind of jumped right in?
So, little secret, I'm 57, but I have twin 8-year-old daughters in my second marriage. So there's no time when you have 8-year-olds for yourself. So it wasn't really an issue. I mean, I'll go down to Arizona in the winters for a month, but that's about where I'm at in my life. So,
Got it. So can you tell us some favorable trends for business owners right now?
yeah, I think one of the most favorable trends that I've seen is the baby boomers who own. I know you know the statistics as well as I do, but I think 5 years ago, baby boomers owned about 71% of all small businesses in America. Now, 5 years later, that's down to 50+%. So the biggest trend I see is these baby boomers are aging out. That presents an opportunity for the younger generation. I've just missed the baby boomers by 1 year. I was born in '66. I think I'm a Gen Xer. But I think for business owners that are younger in that Gen X age, there's going to be a tremendous opportunity to either acquire to grow or find other businesses that business owners want to continue to run. So I think that's going to be a great trend. It will continue for 10 years at least.
So is there any special financial engineering that business owners should be looking at when it's time for them to exit?
Boy, I think the number one thing that they have to get a handle on is their sustainable growth rate. I think most business owners don't understand the concept of growth. They think, look, if you asked any business owner, what are you going to do over the next 5 years? Well, we're going to grow 25% a year for the next 5 years. Sounds great. Okay, so let's look at your free cash flow, right? Well, we got $300,000 in the bank. Okay, so your sustainable growth rate is 6%. So that means to get to 25%, when you do the math, you have to raise capital. You don't have enough money to actually grow at that rate. So I think that's a big mistake that most business owners aren't understanding. So as they get to that 3 years out, 5 years out, and they realize they want to grow quickly and accelerate their value, they really have to understand their free cash flow. They really have to understand where they're going to be able to spend the money and how they're going to get the capital to spend.
So what are some of the ways that you would recommend that, an owner raise capital prior to an exit?
Well, there's just traditional methodologies, right? There's debt. When we raised capital throughout the process of our firm's 12 years. We raised $3.5 million of debt. That was friends and family round. We did a Series A round of capital and equity side. It's tricky because as you get into dilution when you raise equity, the business owner can actually start to see their ownership interest decline and possibly decline dramatically. So it's kind of a balancing act. They have to decide whether if it's going to be debt, then obviously there's the debt repayment, and they have to have good credit, and you have to give them a credit score and go through that process. If it's going to be equity, they need to understand where their point of no return is. In other words, if they drop below 50%, are they going to be able to get the multiple high enough to where they were when they were above 50% in order to break even on that transaction? So, it just depends.
Can you talk about the impact of taxes on an exit?
So I can personally attest to that one. So I live in Minnesota. It depends on the type of transaction you have, right? So that's another thing I think that we could have done better in our exit. We did very little tax planning because it all happened so quickly as we got towards the capital raise. So it depends on how your stock is set up. But in our case, we had a holding company and it owned all the individual stock for the business, which was operating entity, which is a separate entity. So in order to raise capital, you needed to be an S corp or a partnership, right? Because you can't take capital without changing your tax status from anyone but an individual in a sub S. So from a tax standpoint, Minnesota, the capital gain tax rate is the same as the income tax rate, and the highest rate right now is around 10%, just in the state of Minnesota. So for me personally, the combined capital gain rate at the federal rate level and tax rate in Minnesota, that puts me over 32%. Could I have done better planning? Absolutely. First of all, there's residence issues, right? I could have looked at living somewhere else or getting my residency somewhere else ahead of the sale, which I didn't have time to do. There's trusts that can be set up ahead of the sale. So a lot of these things have to be done though, well in advance of the sale so that you can get them out of the way. But yes, taxes are a huge differentiator in a successful exit versus an unsuccessful exit.
So when the transaction finished in the previous company, did they, I don't want to say this the wrong way, did they cut you out, so to speak? Like you were just out and that was it?
I think it was mutual. I think I put 18 months in post acquisition. Look, being the visionary of a firm for almost 14 years and 30 years as an entrepreneur, the other CEO had his vision and they bought 60 firms. We were the 34th acquisition. So realistically, it just was time for me to go. I mean, I wasn't going to be running the business in the sense that I wanted to anymore. So it was just a good time for me to exit.
So it was just that transition period.
It was. I did stay on for, like I said, 18 months. I helped them get, everything set up here in Minneapolis for operating the business. And I think the critical part is you don't want your key people leaving. So I wanted to make sure that if I took the time to do it right, we could convince everyone, specifically the senior leadership team here in Minneapolis, to stay. And I don't think we lost anyone, really. I think everybody stayed with it. So that makes me pretty happy.
So during that transition, did you put any retention plans in place?
Absolutely. And our process was a little bit longer than most because we had to do it through the COVID period. So we went to the markets twice. We came to the end with a buyer back in 2021, early 2021, and that buyer bailed out after they did middle of their due diligence. They decided to build it rather than buy it. So we had to start all over again. And so it took another 9 months. So our exit was almost 16 months long. But during that period, I had a chance to lock down some of my key employees. So I put not just longer term lockdowns, but some short term things too, to stay on for a year after the transition. So most of my key employees had a 1-year retention bonus if they stayed on. Particularly my chief investment officer and president, I gave him a really large retention bonus. And he's been there since. So he's very happy. He earned his capital. So that comes out of the buyer side on the transaction, but I think it was worth it.
Okay. So how do you approach that conversation? Because a lot of owners are thinking like, I'm going to sell. Do I tell them my key leadership before? Do I tell them during? Do I tell them after? Like, how would you approach that? Or what's the best way for people to approach
I think it's a great question. I think it depends on the age of the owner. I mean, if the owner's 60 plus, everyone in that leadership team knows that they're going to exit, right? It's not a secret that you're going to retire eventually, right? So I think if you're 60 plus, maybe even your late 50s like I am, you need to let your leadership team know what your plans are. because they will look around. If they don't know there's a plan in place, they will start to look around because they don't know what the future looks like. So to me, it's critical that they tell their employees, particularly the senior leadership team. Now, if you're 40, 45, maybe it's a few key people in the leadership team that know about your exit or your potential sale. I just think there's no surprising the employees. I think that's a terrible idea. Drop a bomb on the employees. Hey, by the way, we hired an M&A firm and we're in the last nine months here. We're going to sell.
So, and the reason I ask that is because I'm talking to an owner now who actually did approach the conversation about 6 months ago with her leadership team, and she's interested in exiting, and they're all prepared for it now. So now that she's talked to me about it, now we can move forward. And the people that are potentially going to acquire with me, they understand that she has these people in place. She's put the retention plan, so I don't even have to do that part of the exit. She's already done that, so that's great.
No, that's perfect. During our exit, our senior leadership team actually was one of the things that they were buying. During the due diligence period, they realized we had a really great team and had built some really quality leadership in our group, and they didn't want to lose those people. So they also got bonuses from the buyer to stay at 12 months or more. So they got stock plan that they had set aside for senior leadership. So to me, it worked out great for them. So they're in a good place. The company's well capitalized, so it's a great opportunity for senior leadership as well, possibly during an exit.
Good. And that brings me to this next question. How much time is needed to plan and execute a successful exit for a business owner?
Yeah, another thing I probably could have done better, right? 18 to 24 months, I would say at a minimum. When you go through the process of the final 2 or 3 letters of intent that come in and they're putting you through their due diligence process, I would say honestly, Alan, we had one questionnaire, due diligence questionnaire was 300 questions long. So that involves your accounting firm, it involves the quality of earnings, it involves your entire leadership team, everything about your infrastructure, all your plans for technology. So all that had to be checked off on that due diligence questionnaire. So in reality, it's way too late to fix something on that list, right? But if you're, 24 months, 36 months out, and you're considering an exit and you're working with a SEPA in particular who can put in place that questionnaire and walk you through it, and you can see where you're missing or there's gaps in your plan, you have a chance to actually address those things ahead of time. And that'll get you to best in class in terms of your multiple. If you have, really great financials, but your infrastructure is really lacking, which tends to be the case almost always, you really need to work on those 4 intangibles that we talked about. And those don't happen overnight. You're not going to change the culture in your business in 12 months. It's going to take some time. So, we always say business planning is something that you should be doing always in your business, should be current. So I really believe that 24 months probably is a minimum for me.
So for everyone listening, you don't wake up one day and decide you're going to list your business with a business broker. When you're thinking about selling your business, that's the moment you start engaging a SEPA, certified financial planner, and so on and so forth. Do not wake up one day and say, I'm going to sell my business. You're not going to get maximum value there.
Well, I think it's more important to even know your valuation at every time, right? Every point in time, and know it compared to everyone else in your industry, so you have an idea from a benchmarking standpoint. So, they call it the 5 Ds, right? Death, disability, disagreement with your business partner. Anything can happen at any point in time. And if you're not prepared with your best possible valuation at all times, you're going to leave money on the table, unfortunately.
So now I kind of want to change gears. We talked about your exit. Let's talk about your current business. So what's the difference between your current services and that of a business broker?
That's pretty easy for me. So a business broker is someone that kind of comes in when you're ready to sell, literally when you're, 4 months out, 5 months out, right? They're going to come in and walk you through a process. Our process was very similar to what's described in some of the SEPA material, right? They did the entire SIM, they did the teaser, they did the NDAs, we had indications of interest, letters of interest, then the due diligence, which took 60 days. Final agreement took 45 days. That's when the business broker is earning their pay. A SEPA or a qualified business coach like me, I'm going to come in 24 months earlier, or maybe even 36 to 50 months earlier, and I'm going to help you get all those things checked off your boxes to make sure that when you meet with your broker, that teaser, that SIM is in the best possible light it can be. So when you're out there being marketed, you're going to get the most interest you possibly can from the right buyers.
And that kind of leads into this question. So I already know the answer to this one, but is it better for owners to begin working with you before securing the services of a business broker?
For sure. It's again, business brokers serve a purpose. There's investment bankers, there's M&A, there's brokers, there's a different names for relatively similar services. And we, like you, I mean, we know really good business brokers that can help you with that process if that's something you need from us.
So what does working with you look like now?
So it's pretty easy going. Look, I want to have 5 to 10 referenceable clients. I want to work with them very closely. My preference would be to be that trusted advisor for the client. And my client, of course, would be the business owners. When I was going through my process, I had an attorney. Well, I had a bunch of attorneys. We had an investment banking firm out in California. We had, the accounting firms, 2 different accounting firms. So we had the quality of earnings as well, which is a whole different ball of wax from the normal accounting process. So looking back on it in the process, I felt like they were on my team, right? But I didn't really feel like any one of those individuals had my back. So for me, as a business a coach or a SEPA, I'm not going to get any remuneration from the sale of the business. That's not how I get paid. I get paid a retainer to work with them month in and month out and tick off those things on the box that we talked about. I want to be that advisor that's there to have your back no matter what. If you have an issue with your attorney, call me. Let's talk about it. Let's figure out, what do we need another attorney. I want to be that trusted advisor that you don't have to worry about, has no skin in the game. It doesn't care about the transaction, right? I don't care about it financially is what I'm saying. So I just want to be that guy for my clients. And that's the way I engage with my clients. So I'm looking for clients that I'll work with for at least 2 years, hopefully 3 to 5 years.
So how do you work with the other advisors for the business owner? So they usually have their attorney, they have these CPAs, they have these other people. So how do you work with those people?
So it depends on who they already have in place. Almost everyone has their CPA in place, but we have relationships with fractional CFOs. I have relationships with fractional CMOs. I've got relationships with estate planners. I've got relationships with financial advisors. That's my business for the last 30 years. So I feel like I can add tremendous value there. But again, I don't want to walk on relationships that they might already have. So it's just going to be a matter of getting to know that group of people. And if there's something missing, we'll fill the gap. But realistically, I'm not in there to replace anyone. I'm just there to see what everyone can do at what level they can perform.
What characteristics do your best clients exhibit?
Accountability. That's probably the number one thing that I see in good clients. The owners are held accountable and they believe in accountability for their staff. Second one really is willing to fail. Owners that are willing to fail and understand that you can learn from your failures. It's a critical skill that I think is sadly missed in today's society. And then continual improvement. They're not afraid to fail because they know that'll make them better. So to me, continual improvement goes right along with accountability.
All right, so we're winding down here. So I've got 3 more questions for you. This first one is, what's your best advice for someone looking to sell their business or transition to a new one?
I think number one is you got to understand your valuation. You have to understand where you currently are compared to your local competitors, your national competitors, and to a benchmark. So to me, number one is you've got to engage someone to give you that sneak peek as to what your business value is today. And during that process, you'll probably uncover, if you ever read the book, Your Baby is Ugly. It's a book about, everybody thinks that their businesses are wonderful until someone else takes a look at it. You've got to take a look through the eyes of the buyer. You got to put yourself in the buyer's shoes and you got to say, hey, I'm looking at this from a whole different lens. And when you do that, I think you can uncover a lot of the things that maybe are traps that are reducing your valuation.
So quick aside here, is that something that your new business provides for the owners?
100%. Yeah, we have a very serious business insights report that we do. It's about 60 pages long. It's heavily focused on about 145 questions, not just financials, but all your intangibles. Typically, there's 15 to 21 places in the business that need to be fixed. And that does take 24 to 36 months. So we'll help them after that create the process to get those things in place. The cool part is once they're fixed, you can actually see in the software we use, you can actually see the valuation increase and see your multiple move up. So they've kind of gamified it. It makes it fun for the owner, holds them accountable, but they can see it. And when you can see it, it makes it more realistic.
What's one of your favorite quotes and why?
My favorite quote I used to use in the business was find work, do work, and get paid. It's just a real simple entrepreneurial quote that I use because that's how all business works.
And how can people get in touch with you?
So you can try my website. It's sawtoothba.com. That's sawtoothba.com. Or you can email me at bradp@sawtoothba.com.
Excellent. Brad, thanks so much for coming on. I appreciate you.
Great, Alan. Have a great week, man. It's great to see you again.
Thank you. You as well.
Take care, man.